PayPal shares have dropped on weaker than expected guidance after their earnings release yesterday. And my question is this stock now too cheap, and is it time to potentially take a look at buying it? And that's what I'm going to investigate in this video. And so guys, as you smash that like button, let me run that intro. What's up guys, and welcome back to the channel. Now always, I gotta say, this is never investment advice. This is just me doing my own research as I was looking at PayPal, because the thing did decline substantially yesterday, and this is what I'm talking about. The shares were down 9.3%, and they just sort of stayed down throughout the day. It wasn't something like an H&R Block where it went down almost 10% and then came back up a little bit. If you guys don't know the story there, take a look at H&R Block's share price or the chart. But really the question is, why did this happen? And largely the answer is that they got weaker guidance than they expected, I guess, the market. And so, you know, we're now in a situation where this thing is kind of priced silly, at least in my opinion, where you're kind of pricing it at almost a no growth scenario, but it might not necessarily be the fact that it's priced at a no growth scenario. There might be some potential that earnings could go backwards in subsequent years. I'm not convinced on that, and I'm going to try to explain exactly why I got to that conclusion. So let's start with the results. So you can see that revenues are up 8 or 9% depending on how you're looking at it, and then operating margins were actually up. They increased year over year. And so yeah, they earned on a non-GAAP basis $5.10 per share, which based on the current share price reflects effectively a 10% equity yield. And when it comes to their guidance, they're expecting revenues to increase in the first quarter. Now, they didn't tell us where revenues are expected to go in the full year, i.e. their fiscal 2024 guidance. However, I wonder that if they're forecasting non-GAAP EPS to be in line with $5.10, which is effectively what they earned in 2023, I wonder if they're expecting an overall revenue decline in fiscal year 2024, or are they expecting a profitability decline in 2024? I don't know if they're going to expect a profitability decline. I think they could potentially not necessarily see a revenue decline, but not see a 6.5 to 7%, or sorry, a 7% increase overall in the year in revenue if this thing is expected to be $5.10 ending off in the year. You know, you could just see profitability decline. Ultimately, it's just semantics, but I just wish that they provided a little bit more color here. They might have provided it on the conference call, and I just didn't see it. And this is what drove a little bit of my confusion. If they're expecting profitability to decline, which is what everybody has been reporting, or at least what I've seen in news articles, why would you highlight this presentation? Why would you highlight this slide in your investor presentation deck where you're focused on driving profitable growth? If I was building this deck out for the CFO, I would not include this, because if we're expecting and if we're modeling out that profitability is expected to decline in the subsequent year, then why would I show this? Because really what this would do is it would make us look like we don't know what we're doing, because we're highlighting the fact that we're focused on profitable growth, and then in the next year profitability declines. So that's why this is a little bit interesting to me, and this is why I do believe that it's revenue overall year over year that they don't expect to grow, and I think that's how they're forecasting it out. It might inevitably end up growing anyways, even just on the back of inflation just pushing up prices, so people purchasing the same amount of goods, but total transaction volume increases, so that could be a thing. But anyways, this is why I wanted to point it out. The fact that they've highlighted this as one of their main slides. This is slide number 6 in their presentation deck. So very important. This is what confused me. And so this is why I wish that they provided a little bit more detail. Now, total transaction volume, or they call it total payments volume, is up 12% year over year. Now, number of active accounts are less important to me because there could be many not unengaged, but what I mean is immaterial accounts. So what matters to me more is total payments volume. And here's where inflation could help a bit, right? Because if the same amount of goods are being purchased and, you know, your year over year transaction in terms of volumes are the same in terms of goods being transacted, but just the level of inflation just would increase your total payments volume as a result. So just think about that when you think of payment platforms like a PayPal, like a MasterCard, like a Visa, et cetera, et cetera. So what does this mean from a consensus EPS perspective? Well, you can see that, of course, the market has changed their forecast to $5 and effectively 10 cents for next year. And then which reflects an 11 times PE ratio. And then, of course, it goes up slightly. So the question is this is really valued in such a way where you're expecting no growth. I don't see any evidence where you're going to see perpetual no growth with the company. And so this is where it becomes a little bit interesting. I do want to make it very clear that I'm not a buyer of PayPal. I don't think I'm going to be buying it even in this environment, just because it's tough for me to understand what the long-term trajectory of the business is going to look like. But it's starting to get to a place where it's getting cheaper and cheaper. If it does go into the, low 40s, mid 30s even, I might be changing my tune, but I don't think it'll ever get there. Even like right now where it is, it seems just very, very low. And when you look at the balance sheet, you can see that they have around $15 billion of cash and short-term investments. Now, they actually break this out later in their presentation deck, and they say they have around 17 billion. I think that's what they said. Oh, actually, that's what I missed. There's a long-term investments here. So add 3.3 to the 15 here. So call it 18 all in. Subtract out the 9.6. You probably have around 11 billion of excess capital, so more than what I was saying, which was the 4.6. So, just live here, did I do this math right? So 9 plus 5 plus 3.3 minus 9.7, you're looking at 7.6. Divide that by 60 billion, which is what the market cap is right now, I believe. So instead of 6.6% of the market cap, you're looking at around 12.7% of the market cap. That might be, not all that cash would be excess cash, I would say, but up to 12.7% of the market cap could potentially be excess cash. And so why does that matter? Well, in the past year, they repurchased $5 billion of security. If you're walking into this year where you expect to earn around $5 billion more, and you know that you're going to repurchase at least $5 billion, but you have some excess capital, $5 billion reflects, what's that number? So 5 divided, I should be able to do this off the top of my head. $5 billion reflects them essentially repurchasing around 8.3% of the business. Well, if they tack on another $5 billion, could they repurchase 16% of the market cap in this year? And so that's what I'm thinking could potentially happen. I think you might see large buybacks in an environment where the share price is depressed. And this just speaks to what I'm saying. So I just condensed the cash flow statement. I put the years up above here. So you can see that they bought back $5 billion of shares last year. I can see a situation where there's a $7.5 to $10 billion repurchase in 2024. So that's what I'm saying to you guys. So be vigilant. Follow each of the quarters. Now, once again, this is not a recommendation to buy or sell the security. I'm not going to be purchasing it. At least I don't think so. But if it comes down a little bit more, I might start getting interested. Who knows? So here's your guidance. They expect approximately $5 billion of free cash flow, similar to what they got last year, and they expect to flow that all out to the shareholders. But there's a reason why they put at least and not approximately for share repurchase. I really think that they're giving you the clues where the repurchases are going to be potentially higher than that $5 billion. And this is where I think, they might settle in at that $7.5 billion, especially with the shares as cheap as they are right now. Now, what I wanted to do is look at what a potential at the money covered call would look like. Now, if this is new to you, a lot of you guys are new to the channel. And if you guys are new to the channel, hit that subscribe button and that notification bell so you can be notified for subsequent videos that come up. But notice that this is a options calculator that I give for free away to you guys on this channel. So just go into the description. You can download this for free. I don't charge you guys. I have a lot of problems, I would say, with charging you guys anything. I'm not the type of creator that tries to monetize you guys for as much as I can. And so I give away value to you guys for free as much as I can. And so, what I did was I took the current share price. Well, the way this works is you enter in the ticker and exchange, and it automatically populates the share price. I put in the exercise date as January 17, 2025, so it's 1 year out. The strike price is $57.50, and the premium that you would expect is around $9.50. So essentially what's happening is, and 343 days is the days until strike, so effectively a year. But essentially what's happening is you're receiving $9.50 of premium, and you could potentially get a capital gain of $1.37 if you are assigned on the covered call, because you buy it at 56.13 and you're assigned on it at 57.50 if the share price recovers a little bit. So your expected return if you get assigned is $25. But the reason why I sell at the money covered calls is to protect my downside. It's not necessarily to make as much money as possible. And so this is the compensation that I expect to lose the shares. And so what is my downside? Well, my net purchase price is $46.63. The way I valued it, I just took the $5.10 and added multiplied it by a 12.5 times multiple to get to the valuation of $63.75. You guys tell me what it's really valued at. I don't really know, but even at a 12.5 times multiple, you're looking at a company that's trading at 73% of what its high level intrinsic value is. But here's the more important part. If the run rate for earnings is around $5 per share, that reflects an 11% equity yield going forward. And I don't see this declining. I know a lot of people do potentially see this declining, but I don't. And so that's where there could be some real value here, where you're effectively buying the company at $46.63. And if you go back and look at the share price over the last 5 years, I don't think it gets that low at all. So there's real downside protection while you get some meaningful premium return. So you guys let me know what you think. Where do you guys fall on this PayPal thing? Are you guys buying more? Are you not playing this at all? Or are you now sort of like considering it at all? So let me know in the comments below. Now, the one thing is, the reason why I'm not a buyer of PayPal securities is because there's a lot of names on my tracker that do seem a little bit undervalued right now. And so I'm sort of just wiggling through these names and adding to my positions wherever I can. But in order for you guys to get access to all of my research, you can get access to that at that low $5 a month level for that low Patreon tier. And if you want to join us for an epic live presentation, you can join us at that higher tier. And of course, as usual, if you find zero value after you subscribe, just let me know and I'll completely refund your first month subscription, because I don't want to take any money from anybody who gets zero value. And so I'll leave it there for you guys, and I'll see you later.